Well, related to the slumping oil price, our next guest says that the Canadian housing market is dancing on the edge of a razor blade, and it's time to get short. Joining us to discuss why and how, Bradley Safalow, founder and CEO of PAA Research, and he joins us from Atlanta, Georgia. Thanks so much for joining us, Bradley.
Thanks for having me.
So we've heard this before, that oil is going to be the final prick that bursts the housing bubble in Canada. But you draw an interesting connection between oil and immigration. Help flesh out your thesis as it relates to oil.
Sure. At the high level, a major element of our thesis is based on the demographics of Canada. The country's birth rate has declined significantly over the last 25 years. So as a result, population growth, which is a primary driver of household formation, is much more reliant on immigration than it used to be. So 2/3 of population growth is now related to immigration. And here's where oil comes into play. You have a situation where since 1867, there's been a positive correlation between oil prices and the number of new immigrants into Canada. In the last 25 years, the correlation has increased significantly, where it's about 0.8, which is obviously statistically a very important indicator that with oil prices depressed, that the country overall may see a decline in new immigrants coming to the country. So you say, all right, if immigration declines and you have population growth, which has averaged about 1% for the last 25 years, of which 0.3% has only been driven by natural birth, if you have a decline in overall population growth, that's going to slow demand for housing overall. Not to mention what we would also see, obviously, with the crude oil situation, significant job losses. We've already started to see that in Alberta. It could trickle throughout the rest of the country due to the other sectors which are reliant by proxy on the oil industry.
So, Brad, you talk a lot about the structural problems with the Canadian market, with the demographics, but wouldn't that be also the case with the U.S. market or European markets, where there's very little growth in terms of the birth rate? I know the Canadian birth rate is weaker than the U.S., but still the immigration picture is arguably a little bit stronger in Canada than in the U.S., for example. So why Canada, I guess?
Well, it's a great question. So we've had strong immigration in Canada for a period of time. I think it will get weaker. You'll see less immigrants coming over. There is an argument to be made that every country or every region, the U.S., Canada, Europe, that have low population growth naturally are fighting for immigrants to some degree, and immigrants are going to follow economic opportunity. And I think in the case of Canada, the big difference now is that you have home prices, which are have increased on basically a straight line for over 25 years now, and the housing markets in general are a lot less affordable. And when you layer in the other dynamic that we need to talk about is, how does currency play in? How do immigrants feel about the economic opportunity, let's say, in the Canada versus U.S.? If you're a foreign buyer or an immigrant and you've bought a house in the last year, for example, if you had bought a U.S. house, you would actually, or a house in the United States, you would be looking at gains just purely on the currency dynamic. If you're a foreign buyer and you bought a house in the last 6 months in Canada, you're looking at in a U.S. dollar denominated basis, you're looking at a 15% loss. So I think some of that, and I know you guys are intimately aware of what role foreign buyers have played, let's say in markets like Vancouver or Toronto, where there's a significant argument to be made that they are driving home prices or have been driving home prices higher.
So to be clear,
the affordability equation, sorry.
Just to be clear, your concern is not with the credit quality of some of these people taking on mortgages, but rather that the immigrant population, which has been the buyer stimulating demand, will disappear?
Actually, it's both. So if we look at the drivers of household formation, the underlying demand drivers over a longer-term basis, they are incredibly problematic. Separate to that, you've had extraordinary home price appreciation, as I know you guys are well aware, and everyone has talked about it, and you've mentioned that others have been concerned about the bubble potentially forming in the housing market in Canada. But if you look at the underwriting standards, and this is a big part of our thesis, is that the mortgage insurance program in Canada, which is generally viewed as something that keeps underwriting standards very conservative, I would argue creates a huge agency problem, and the data supports this, in that you have someone, there's a large pool of loans, 15 to 20% of loans in Canada that are insured are issued to borrowers that have sub 700 FICO scores, and they're getting loans at, let's say, a 2.5–3% mortgage rate. I don't think there's anywhere in the world, literally in the world, where a similar borrower with that credit profile could actually get that kind of mortgage at that rate. So is there a credit problem? Sure. We're pushing up against the upward bound of affordability. In many markets, you're talking about the average buyer. In our research, we did an extensive survey of 300 plus real estate agents across the country. What we see is that most borrowers, most home buyers are actually putting 5 to 10% money down. If you look at the affordability in that context, they're allocating 40% of gross income to just pay their mortgage. That is an extraordinary high level. And if you look back at what happened in the U.S. and in the housing downturn here, the levels in terms of the debt servicing costs were much lower that caused the housing market to turn over. So I think while I know the government is somewhat comfortable with those levels, I think the issue here is that you're at the lower bound on mortgage rates. The consumer is completely stretched in terms of servicing that debt. So if you have any sort of negative variance, whether it be jobs, just a slowdown overall, the credit quality situation will become very apparent that there are a lot of borrowers out there that are extraordinarily stressed. And that's what we expect to evolve over the next few years here.
All right, Bradley, we'll have to leave it there, but thank you so much for your thoughts. That was Bradley Safalow, founder and CEO of PAA Research.